Benton.
JW. Ladies and gents.
How are you, mate?
Friday to you.
Friday. It's Friday.
Oh, and I should add some channels in here as well at the same time, shouldn't I?
Yeah, mate. I'll pump it up. The more the merrier. Stream away while we're waiting for everyone to jump in and the old stream's warming up. There's a few early birds. I've been MIA for a couple of days. Actually, we both have. We've been doing a little bit of training on our coaching businesses for a couple of days with Taki Moore. Week before we were with Kerwin. Yeah, we've been a little bit MIA in the last few days. So no wealth coffee chats for me the last few days. But there's a few people jumping on. There we go. Jeff, mate, how are you? Good to see you, Jeff. Took a sick day. Oh, no, Jeff. The old gout. Yeah, plays up a little bit, the old gout. Alison, good to see you. As always, fantastic to see you. Anyone else in there, give us a shout out. Team, folks.
Where are you coming in from?
Friday. Yeah.
What's going in your world at the moment? It's in the year that we've dubbed the Great False Start. What's happening in your neck of the woods? Are you well? Are you getting back on the feet? Ross is little Honey's adventures from the sunny coast.
Hey, Roz. Good to see you.
There's a bit of story behind there for Roz, and and the Oracle Ashley is in the house, bringing Neo back. It's Friday. We've got a Facebook user, unidentified, who is adopted your saying, Jace. Friday,
folks. Friday. I think the old Facebook does something a bit bizarre and strange sometimes in there. But whoever you are, great to have you here. We know you're in one of our groups, our private groups. But there's Jeanette. Great to see you, mate. As always. Mate, I discovered, folks, Andy gave me a nice bottle of wine for my birthday, I think it was. And I was scratching around in my cupboard, I need some wine. I'm like, wow, that I didn't know that was there. And it's a 2011 Yeringberg Yarra Vale, and Andy reckon it's a top drop. So thanks, mate. Looking forward to that. I promised Andy I'm going to drink 2 glasses of wine today. So today's Wealth, Wine and Wisdom could get a bit loose, folks. So stick around for the show.
You definitely cannot let that sucker down for a couple of days. It's an absolute cracker. It's from my backyard. It's from, well, not literally my backyard, about 45 to an hour and a half in the Yarra Valley, mate. And it's an absolute belter. It's an absolute belter. I feel like I've really shortchanged myself, and I'm still drinking a good bottle of wine here from our good friends at Levenstein Hill. Which was part of your mentoring. Mate, that's a cracker, but I don't think that they'll mind me saying it's not going to hold a candle to the liquid gold that you've got at your place today. I love the Wealth Coffee chats in the background there, mate. We'll have to get a Wealth, Wine and Wisdom sign up the back there too.
I think so. I'm thinking I need one that sort of double whammies on that. So we'll get working on that, folks. But good to see you, mate. Good to hang out with you. And thanks, folks, for joining us on a fantastic Friday. We couldn't make it last Friday because we were both at Kerwin Rate. A few of you guys online know who that is. And today we're back. And we're gonna hang out for the next sort of 45, 50 minutes, talk about what's going on. Little bit of intro, folks, just for most of you know this, but if you're new, let us know. But, you guys know that Andy and I started this connection, debrief, connect, because of the crazy world that was the COVID lockdowns. And we wanted to support you guys and debrief the week because things were changing so quickly from the property world, the business and finance world. And we'd have a glass of wine and chat about what's going on. And so it's flowed into something fun. We enjoy it. I hope you guys do too. So hang around for the next 45, 50 minutes. We've got a little bit of a process that we like to go through. And, some of you guys know this one. We like to do what's on in the news. We'll debrief that. There's plenty going on out there, actually, Andy. It's pretty newsworthy this week. And I think as the world is, well, our little world anyway, is winding up for budgets and elections, I think there's a little bit of interesting conversations to be had, folks. So hang around for that one. We like the idea of doing getting some questions from you guys. So if you have any questions, type them in the chat right now so we don't miss them, and we could probably answer them along the way.
There's been a few of you who have reached out during the middle of the week. You know who you are, so drop the questions in nice and early so we can see them, and we'll do. We won't do our best. We'll get to them nice and early if you do that. So whack it in there, hashtag Q, and whatever your question is, and we'll come to them.
We'll make sure. Well, John O'Reilly, good to see you, brother. There's the wine, my friend. We're having a nice cheeky glass. Hopefully you can join us, Roller.
And I think Roller wants consumer sentiment, and mate, from the consumers of this wine, it's pretty damn good, Jono. It's a good consumer sentiment over my side of the woods. How's the consumer over your side there, Jace?
Very happy with this wine. I can tell, Andy. I can tell. So I think maybe with all your coaching and support, I'm getting better at understanding what a good wine is. So that's fantastic. And mate, folks, last but not least, here's an idea. Maybe there's a few things we should know, and a bit of general knowledge. We might teach a little bit of that a little bit later on. So that's the general gist of it. We always kick off. Yeah, are banks becoming easier? Well, Ashley, I'm going to get onto that because old APRA is back at it as well. So that's part of my little rant this morning or this afternoon when we kick off into our first part of the day, our first section of it, Andy. So I might we've got a couple of little bits on my slide. I know there's plenty that you've got on too, so I'll knock over a few quick ones, and I'd love to get around to where you're at as well. So
spotlight yourself, and I'm just going to go and open the door because I need to get some ventilation in here. So wax,
right, mate. Oh, mate, I'm good at that. Don't you worry about that, folks. Well, while Andy's disappeared, I'll put myself somewhere in the picture. There we go. Let's do what's in the news. Hey, listen, just a quick one. Out there in the marketplace, Ashley, this is part of the conversation. Yeah, part of the conversation that I wanted to have with everyone today. Funding. And Andy, you and I have chatted about this. I mean, I love our conversation about you believe the future of pricing is going to be based on risk, not old-fashioned, and based on supply. Well, really interestingly, Andy, APRA, and this speaks to your question, Ashley. APRA just came out, and I bloody saw it, and I should have snapshotted it, but APRA just came out with some new proposed structures in and around, Andy, pricing people's debt in exactly that way. They're saying, hey, listen, guidelines for lenders. Hey, if someone wants interest only 90% lending as an investor, well, that pricing's a bit higher. And if you want 70% lending as an owner, occupier, and principal interest, well, that pricing's a bit lower. And this is how we should. And maybe I'm not giving APRA any kudos here because they shit me to tears, these guys. But
this is the way that it is operated in the bond market for hundreds of years, and this is the way that all debt, apart from housing prices or effectively mortgage price, has happened since the dawn of time, since Caesar. Hail Caesar, Jace. It was right back then. It was exactly the same thing. It was risk versus reward when it comes to debt. If you're a big risk and you reckon the Romans might have taken you out on the way through, then they're going to want a little bit more for their penny. And to me, it makes sense. And I understand, the fors and against, but low interest rate environment, it makes sense to be able to price on risk.
Price on risk.
I think we've been talking about that from the very beginning,
mate. And this speaks to your comment, Alison. As long as we can get still 90% lending, I'm at 100% with you. 90% lending is actually, if you can, and it's safe enough, then absolutely do it because, it gives you as a property investor, a little bit more bang for your buck. But here's what I think is going to happen. Here's my call, Andy, for the future. And you and I have talked about this as well. Private money, private equity, private debt is going to be something for the future as well. And I think for all of us, other than being involved in the sort of the regular lending world, which is banks and, we're going cap in hand, I think the private debt market, Andy, is going to be much more flexible into the future. And Alison, for all of us, I think that's where we're going to start to see some opportunities for us as investors where the pricing's right, and the risk understanding is right, we're going to see the ability for us to seek debt in another way. Maybe, Andy, what we might call, an appropriate way for the risk and reward. I think that's going to be big. I think it's going to be massive. There's more money in circulation today, folks, than there has ever been in history for all sorts of reasons. The Australian property market increased in wealth 3 trillion. Let me do that again. $3 trillion in the last 24 months, right? Australians have got more money than they've ever had in history. And much of the world is in the same shape, Andy, after COVID in certain places and spaces. And that money needs a home and it needs to go to work. And Andy and I have talked about this. Money's looking for places to live. And actually, defensive assets, which is why I put this one right next to it, Andy. I'd love to hear your opinion here. Got someone saying, hey, listen, bonds won't exist in 10 years. They're gone, they're dead. I don't know about that. But, maybe the world of defensive assets when it comes to real estate and mortgage-backed securities and bonds, maybe it's just changing shape right now because the world's got enough money and money's cheap and the friction's gone, Andy.
And for me, that's the key word is friction.
Yeah.
Again, this is just opinion piece, but my opinion is 100%. It'll be that here's the thing is that there is crypto is no different to where we've come from. It's just more efficient.
Yeah.
It's just a different mechanism. So think of it. It's like taking your notes in an old fashioned binder folder. And then all of a sudden you're taking it in OneNote or on Evernote or on whatever note-taking program that you're using. Your notes are now so much more transportable, so much faster to be able to access, so much faster to be able to see and grab a hold of. And that's my parallel to, fiat, exchange, bank. Like what a lot of people don't actually understand until not very long ago, banks used to run overnight tape. Like think of a 4-track recorder. This is no shit. This was less than 10 years ago. And I think some of them still run. I don't know. It's been a while since I've been at the cold face of banking. But there was almost like a tape reconciliation that was going on a day-to-day basis with billions of dollars or hundreds of millions of dollars, depending on the day. Now, this just enables a faster transaction rate. But let's have a look at what banks do, right? Well, let me ask you a different question. Jace, you're a magnate. You're making a stupid amount of profit. For every dollar that you've lent out, you've actually lent 16 times that. And for every dollar that you've lent out, you're earning around about, a business EBIT of about 4 or 5%. So it means you're now, 30, 40% sort of EBIT numbers. And I come to you and I say, Jace, it's going to cost you billions of dollars, but I've got a way that in 5 or 6 years, the world will start to grasp a faster way of you being able to operate. It's going to cost you a lot of money. Nobody's going to understand it for a long period of time, but ultimately it's going to better the world. It's going to better the community. It's going to better the economy, everything. Are we going to do it now?
No, they won't. They won't do it because they're like, hang on, I'm on a good thing here. Yeah.
100%. And ladies and gents, it goes under the very valid is that the banks, like everybody else who runs a company or a listed company, they have to work in the favor of the shareholders, and shareholders are represented mostly by profit. Not actually the case, believe it or not, is that shareholders can ask for a philanthropic cause and to cut profits if the majority vote for that direction, but usually they don't. They go for profits. Anyway, off my soapbox, Jace, back to you.
Now, listen. So, folks, I think the future, in which sort of speaks to Alison, and Ashley, talking about the availability of credit. Andy, you and I were talking about this the other week as well. We got asked the question when we were up on stage the other day. And it really is, folks, the big thing, I think, for the future to keep an eye on is the access to credit. I actually think APRA won't make the same mistake it did last time, but it is trying to get in there and manipulate some things. The agenda is not quite clear just yet to me, but I think there's something behind the scenes that I want to sort of discover. But Bob was asking about, what about the yield and it inverting and other things like that. Those things are certainly there's certainly something to look for, but I think those conversations are changing, Andy. Like what it used to be is not what it's going to be, and there's kind of this. We're in this transition from what used to be and what's going to be this brave new world. So I reckon it's going to take 5 to 10 years to transition. Crypto, private lending being the norm. You know what might happen, Andy, and folks listening in. You might go to the main bank. This is what happens for developers, folks. This is what happens to the professional people in the real world. This is what happens. I want to get a project off the ground. I'll go to a main lender and I'll buy debt at 60% of something, and I'll buy it at 3%. That's what 60%. And now I've got to make up the difference between how much I'm putting in. I want to put in 10%. The difference is 30%. And I will feel the difference, like professionally in commercial lending. I will get a second lender, and I will get maybe an equity or a joint venture partner, and I'll feel the gaps. The second lender lends me 20% at 10%, and then the equity partner will lend me 10% or become a participant for 20%, and the blended rate across the whole thing, might turn out at 5 or 6 or 7, and like that's actually, I think, what's going to happen in the future, Andy. A very different version of that. But I think private lending, I think people will be able to top up 80% to 90% lending from private. I'll lend you 10% at a 8% interest rate, Andy. You can go and borrow the other 80% at 3%. Your blended rate is 4.2, and everyone's a winner. That's what I think. I think that's in the future for residential real estate. And I think there's some mechanisms in place that will allow that to happen, but they're not mature yet.
And look, I agree in the philosophy. I don't know about real estate, so I don't know where it'll sit. But the one thing about private money is that it goes to the highest security for the best rate.
Yeah.
Because private money is smart money. And it's going where it can get the greatest amount of capital guarantee for the least amount of risk and get a bit of a premium. So cocktail. No, not cocktail. Not cocktail lending.
That brings some GFC connotations in there, doesn't it?
No, what Jason's talking about is how smart institutional money can actually work, and how you will always hear that very wealthy people never use their own money to get rich. That's effectively what Jason's talking about. Now, that kind of mechanism is at the moment that's isolated for your sophisticated investors, or it's available in the retail market through CDOs and collateralized debt obligations that nobody wants to buy anymore because the world blew itself up. But the point being is risk-based lending, and it comes back to Jace's point here about Agora is talking about digital currencies. Yes, I think that it's going to be there. Now, what I don't mean by that is don't go out and buy Bitcoin and stuff like that. I think that what you'll end up with is a far more stable universe of coins, and there will be different kind of mechanisms to them. But the ability to make fast decisions as to how your money is deployed from a risk perspective, I think that is going to be a very interesting place to play. And the key reason behind it, which I think Jace is alluding to, is that at the moment we are still in low interest rate territory. Personally, and I'm a peripheral visionary, I can see into the future, but just way off to the side. But generally a little bit,
I like that.
A little bit closer than your average economist, though. Oh, you're a good economist. But I kind of see that it would be hard for us to deviate from the path of Japan too much. And what we're seeing right now is the Reserve Bank is being very, very cautious about how it's judging inflation. Because right now in Australia, inflation is above its target rate.
Yeah.
And the Reserve Bank are saying, oh, we're thinking about it, trying to scare the market a little bit, trying to tame things a little bit, because they're a little bit scared, I reckon, about raising things too fast because it can have a really big effect. And so maybe we need to look at other things within the market, innovations, in order to be able to restabilize what used to be term deposits, government bonds, term corporate bonds, things of that nature.
Yeah.
A long way away from the cocktail lending.
Yeah, yeah, and I think, yeah, and I like your sort of out into the future, but off to the side. I feel the same way. You know, Andy and folks, we've talked about this, and this is opinion piece right now. Really, at the end of the day, you know, at some point, someone's going to crack this code, and maybe Andy, you and I might even do it. You know, everyone has a certain amount of equity that's going to be sitting in their securities. You know, real estate's a very understandable security, has been for thousands of years in the economic system, Andy. You know, and so I think the idea of smart contracts, you know, smart contracts, folks, the digital world, you could technically lock up $100,000 of your equity with ever after refinance, and then allow someone else to use your equity as security to do something else, but you get paid for it. That's going to happen that's going to happen in the future. I think you're right, Alison. I'm sticking to my promise of drinking 2 glasses of this good wine that Andy gave me, and I'm actually entering my second. So, you know, watch out.
I've forgotten whether it was maybe we should go back to, was it Shane or Ashley who said, let's jump on the tequila? Maybe that's the solution.
Oh, that could end things badly. But, you know, yeah, for sure. And Hardik, equity isn't debt. And this is an interesting thing. Like, you know, we're taking a different tack here on this conversation, but I think it's a great one. Equity, folks, is untapped, unrealized, unused potential. That's what it is, right? And, you know, for all of us as investors, if we're sitting there, if we own something that is worth more than we owe on it, and the downside of owning a principal place of residence, Andy, you and I teach a PPR upgrade strategy for wealth into the future. The downside of owning an expensive home, which is worth $2 million, and you've got $100,000 debt on it, is you've got $1.5 million worth of value, creating 2/5 of, you know, all income for you. It's useless, right? And so what are the alternatives? There's kind of this black or white version of the world. And I think there needs to be this blend, this gray version of the world. Maybe, I don't know.
I think we'll call it lifestyle equity, Jason.
A lifestyle equity. Yeah.
There you go.
Absolutely. Yeah. It's a good one.
And it is. It 100% is. You know, there's people who ask the question as to, you know, what, you know, how do we become richer without necessarily being able to put too much more money in our pocket? And the answer is very limited. If you do have a big principal place of residence, great, safe, wonderful, not tax deductible. If it provides you with the quality of life that you want, wonderful. But it's lifestyle equity. And the price that you pay for that is potentially having to sacrifice the future or downgrade that principal place of residence. And as a part of a strategy, that's fine. It's great.
Yeah. If it's part of your strategy, Andy, it's almost like
lifestyle equity.
Yeah, it's a vanity balance sheet, right? It's a vanity balance sheet.
It's a jet ski.
Yeah. Yeah. It is a jet ski. You enjoy it once a year. And
well, anyway, last couple of years were good, mate, because if you did have that lifestyle equity in the property, it was a nice place to hang out for a couple of years down in Victoria.
Totally. But, you know, it depends, Ashley, Hardik, you know, you guys asking some good questions, you know.
Great questions.
Yeah. And, you know, Sabu, you know, like, you know, is it worth refinancing? And the answer is it depends, Sabu. What's your outcome? Where are you now? Where do you want to be? How long have you got to get there? You know, for me, the idea, Ashley, is, you know, Andy's been working in financial planning for decades. You know, there's nothing worse, folks, than arriving at 60 going, what do I do, Andy? And Andy's going, well, you fucking should have seen me 20 years ago. That's what you should have done. And we should have had this plan in place for 20 years. It's very difficult to arrive somewhere without having done the right things at the right time and get a good outcome, folks. So, you know, the answer, Sabu, is like, is refinancing worth it? The answer is yes, if it's part of the plan and it's structured for your future, and there's other things, and I won't dive into it today, but if you track down a little video I've done called Equity Lock, mate, search it on YouTube and on our Positive Real Estate TV videos, Equity Lock. It's absolutely worth it. What happens, folks, is we are conditioned. We're conditioned to reduce our owner-occupier debt. And who gets rich by you paying your home off, folks? Tell me who gets bloody rich, because you don't. I'm telling you right now, who gets rich? Tell me. Put it in the chat.
Hardick, you've put him up on the box, mate. Hardick,
I'm fired up now. I'm fired up.
You're not going to get him back down, mate.
Who's getting rich when you're paying your home off, folks? Because you're bloody not. I can tell you, because when you pay your home off, it's not creating any income, right? The banks are getting rich, folks, okay? Because the banks, like Andy said, is they take your equity, they securitize it, and then they go and lend it out, at a ratio of something like 16 to 17 times. Yep, absolutely. So anyway, I better not get wound up about this one. Yeah, and Hardick, you're right. Andy could probably speak to this one about, the appropriate time of, talking about, it's not SMSF. Let's take that off the table, Hardick. It's about, when does super become, the right vehicle, or a vehicle of choice, potentially, not necessarily the right one. Those things are, part of our overall strategy as well, mate,
Right. And Hardick, here's the simple formula: PPT. It's purpose, place, and time. And with any investment, that's really what you need to be looking at. What's the purpose of it? What place does it have in my world of wealth creation, or maybe wealth stability? And what time am I, or what time is it in my life cycle? And I'm a big believer that you use super in a very specific way, and that there are times when the government is a greater risk to super than the investment. And anyone could argue that. My opinion is that at a point in time it is, because you're so long to being able to touch it. And so it's a matter of going, well, how do I make things work best for me given my life? And the problem is with our life, Hardick, if we all knew that we were going to get to 100, we'd probably play the game a little bit differently. And we probably all have a pretty similar game. But we all know that, unfortunately, life is very short for some of us, and sometimes, unfortunately, really long for others. And I say that quite legitimately. And the game, as far as I'm concerned, when it comes to a wealth game, is kind of trying to go, well, based on the way that I want to play my life today, for tomorrow, and for the future, what's the best strategy? And I guess the best way that I can point you, I know that I haven't given you anything other than questions, but is to ask great questions about, like, how much risk am I willing to take today? How much of my lifestyle do I want to sacrifice? Because I know some very, 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 very happy people who have just lived hand to mouth because they enjoy the moment. But here's the thing: is they don't bitch and moan when they get older and they realize that there's not going to be what they want there. And it's about making the choices with an understanding of where you want to be in the future.
Yeah. Yeah. And there's some conversations, Alison, like Andy, you were the person I stole this from, which is great. That's why I love hanging out with you. The biggest risk to any investor is political, not anything else. Right. So yeah, Alison, I think they will.
How true is that? How true is that? Like, just whack a hell yes in the chat if you believe that to be true. The biggest risk to your investment in your business, the biggest risk to the amount of tax you're going to pay, the biggest risk to your investment is the government. Like, just whack a hell yes. I want to see how many of you actually that lands with.
I reckon everyone will be doing it, man.
I hope so.
Yeah. Well, and Alison's got, do you think they'll do caps on super and stuff like that? And the answer is yeah, they will. And however, Andy, maybe you might agree or disagree on this one. Listen, even if they mess with it, even if they
they're coming through now.
Yeah. Grubby government. Yeah, exactly. Even if they mess with that stuff, it'll still be better than not. It'll still be better than in your own name or other vehicles, right? That's kind of where I think, hey, right now, folks, if you didn't come along to Andy's presentation the other night at mentoring, well, you bloody missed out. It was amazing. Tax-free lifestyle for a couple of $220,000. Like, that's on the table right now for everyone, right? Now, the government might mess with that, folks, but they won't mess with it. They won't take it away 100%, is my belief, because they can't afford to. But they might mess with, it more over and above that, Andy, or they might come down and reduce it to 180 or something like that. But, that's the
Well, at the moment, they're talking about 5 million as the cap.
Yeah.
And to be fair, like 5 million, okay, fair enough.
Fair enough.
I'm not greatly opposed to it. I kind of go 5 million, but okay, fair enough. Like 5 million worth of tax-free funds or tax concessions. And at the moment, it's 1.7 million per person worth of the ability to be tax-free. And I say the ability to be tax-free. It doesn't necessarily that you're going to get there. You have to do it the right way. They're making a lot of hurdles and they're making it very complicated. Which is great for us, Jace, because they need people like us to guide people through it. But it'd be nice.
This is the thing. This is the thing, Andy. You and I, in our professions, exist because the government makes it so bloody hard, to achieve what they say is every Australian's right. It's like you're like, everyone, we want to support you. No, you friggin' don't. You make it too complicated. But I'm with that. If everyone can have a 5 million, I'd vote for it if they took away all the hurdles to get 5 million in there. I mean, seriously.
That's hilarious, Jason. That's hilarious.
Just imagine. But anyway, there you go.
It'll be the headline. We've given you the ability to get $5 million into a highly tax concession vehicle. And then the comment that nobody will respond back with is that you've also created laws that mean that it's impossible to get that much in there.
It's ludicrous, isn't it? But folks, if you were at Andy's presentation the other night, if you've got a 10-year runway, you can actually achieve that. Maybe 10, 15 is probably the time frame. If you're smart and you're considered and you're strategic, then there's a runway. And even Andy's been twisting my arm on, buy well, maybe sometimes strategically sell.
Oh, mate, you can't. Here's the beauty: is you can't. The one thing isn't always right. But I do want to just jump onto the question that just came up, and it was a paired user on Facebook there that was saying, so do you cash every cent of your super and the day you turn 60 and stick it under your mattress just in case? Probably a little bit tongue in cheek, but the answer is definitely no. Like what we're talking about is or what I'm talking about and what Jace is alluding to here is if you're between the ages of, say, 16 and 30, right? Well, if you're at the end of that spectrum, 30 means that you've still got your whole life to live again, plus 5 years, before you can access your superannuation under a standard term of release.
Yeah.
Now, if you look back in time, how many times have the governments changed the laws into super? A lot. And how many times have they done it to your benefit? Arguably, they'd say it's all for your benefit, but I think we all like it. So, no, that's not what I'm saying. I'm saying that if you got it in there and you're 60, man, you've got some incredible capabilities of doing some really, really cool stuff. And so I would certainly be, not taking it out unless there was a very, very compelling reason.
Totally. And, 1.7 be nice. Joe, mate, absolutely. And, the thing that Andy and I firmly believe is every single person with a good strategic plan and the right time frame can actually have a plan to get to 1.7.
Like potential. Absolutely.
Every day. Like that's what we firmly believe in. And, that's what we've spent, our last, 20 years as professionals refining, because, the gist of it, team, is, wealth is about how much you get to keep, not how much you make. And the keep piece is about understanding where the most efficient place to keep it is, right? That's where you have to have smart people like Andy on your team to bloody be looking at all of that stuff, day in, day out. They love it. I know Andy sort of, every time he goes to the loo, he's got, the super handbook, to read rather than the magazines, like that's the time.
It's a bloody terrible existence. You're making me out to be quite the adventurer, Jason.
No, I'm just making fun, folks. I have been known, and my wife is horrified by this, but I had a tax manual sitting beside the loo, and every time I'd go to the loo, I would read a few pages of the tax manual. So maybe that speaks volumes about you and me, Andy. Maybe I should stop drinking right now.
That's the reason why you always used to have a shit sleep.
That's funny. Well, listen, mate, I might finish with this one, and I might throw to a couple of others. I think there's a few things in your world that might be worth chatting about, but this is really interesting for all of you property nuts like me out there. Check this out. This is dwellings per 1,000 people. The difference between year 2000 and year 2020 as a ratio in countries. And, the orange is 2000. That was the year the Olympics was in Sydney. And, 2020 was the year that wasn't, with the old COVID connection. And it wouldn't have gotten any different in a year and a bit. Look at the ratio, folks, of a 20-year change of 1,000 people ratio per dwelling. And Australia is in all sorts. And this is where, it's an interesting one. And this actually speaks volumes, over 20 years, because we've actually had a 20-year real estate supply chain issue in Australia. And
Jason, I think I'm going to go shopping in the Czech Republic.
Mate, the other way around. Check it out. Iceland, Czech Republic. Yeah.
Jesus.
Yeah. Good places to be.
It's reversed. That's
amazing. There's 3 places, right? And it's interesting. UK, Sweden,
wow.
And like you have a look at those places. It's an interesting thing, isn't it? I saw this one the other day. Shout out to Timmy Boyle, good mate of ours. Like he finds all sorts of awesome stuff, mate. And you think, all right, well, how does this work? What's going on here, right? The reduction and not the increase. And this is why I'm very bullish. Even though I'm one-eyed, I look for positive bias when it comes to real estate. That's me, like completely 100%. Property person. However, some of this statistics and information is pretty interesting when you look at it. So
this is an incredible slide, Jace. There's a lot that goes into this, isn't there? Who reckons? Yep. Hell yes, if you reckon this is a very interesting slide. This is a bit mind blowing, mate. To be fair,
it is, and I thought you might enjoy one like this, because you love a good bit of good data, and I guarantee your mind's racing. I'm like, well, how the hell? What the? So really, at the end of the day, we've spent 20 years, folks, and our delivery system of real estate has literally done 2/5 of bugger all. Like it's actually like it's just hasn't it's failed. Czech Republic and Iceland too. Arguably the other countries around the world have got better delivery systems for their citizens than those other countries. So it's an interesting one to have a look at. And this is one of the sort of really high level prime reasons why I believe the next 3 to 5 years in real estate is going to be, fairly comfortable, nice place to be as an investor. And, maybe going back to, that question about yield curve and stuff like that, maybe that's a question for you, Andy, but, in the yield world of real estate, we're already 6 months, 12 months into like the biggest rental boom we have seen, in Australia's history. Like telling you, it's record. It's another record, Andy. And
we're reaching record highs or lows. Record highs.
There's no evidence to that. That's just the wine talking. Another record, but
this is something you won't see in the Fin review.
But matter of fact, we did. I don't know if I showed this. Actually, I should go and have a look. Yeah, it was in the Fin review. And I wanted to do a little, I bloody told you so, you blokes. Ladies and gents, where was it? It was, nah,
Well,
I'm
while
getting,
you're finding it, Jace, you might appreciate this. I was chatting with Angus McLeod, who's an
there we go.
investment specialist at Morningstar just the other day, and I've got some cool slides that maybe we'll get through some of them today, but we'll definitely have a chat about them next week. And he actually, and I know that you already know this, but I'd never joined the dots because we were talking about saturation, and I was talking about the velocity of money, like we talk about a lot, and how information is so quickly accessible. And so that now, by the time in equity markets that people see a devaluation in their portfolio, quite often it's too late to make a decision. And the best decision is to hold, unless there's something majorly structurally wrong with the whole world.
Yeah.
Right. And so we were talking about that. He's going, well, funny you should say that, is because, the media, because I said, these are the conversations you don't hear in the media. And he's going, well, it can't be in the media because nowadays all of the journalists, they get paid per click. And I'd never thought of it from that perspective. Journalists paid per click.
That's crazy.
It makes sense though, doesn't it? Because where do you read the Fin review, Jace? Where do you? I've got the app myself on here, but quite often, if I want to know what's going on, I scroll through the feed.
Yeah.
And so then if you're on the opposite side of that as a journalist now, and it'd be great to speak to John O'Reilly about this. I reckon it'd be great to get John O on the show to talk about how this would impact on media and different franchises. But the journalists are actually paid per click. Now, maybe not literally, but as a theme, the success based on how many people hit on a headline in the Fin review. So hence the reason why it's inflammatory and tries to make people do things, which is click on, but the ramification can sometimes be do the wrong investment move. Anyway,
isn't that just, well, whew,
right?
Yeah.
It was a really interesting take from a very, very, very analytical person.
Well, there you go, man. Well, journalists not writing about the thing that they need to shed a light on or shed the truth on, but yeah, geez, okay, well, we got to sit on that one. That one's gonna percolate. Yeah. Wow, there you go. Well, speaking of Fin review, like this is what popped up the other day. I've been talking about this for over 12 months, folks. We're in the middle of a rent boom. It's happening. And I think this is just, this is just going to be reflective of what's coming, Andy. Mate, I'm going to stop rabbiting on, and I want to give you the stage because I know there's some bunch of stuff that we wouldn't mind sort of, peppering out there from your neck of the woods, because we got the budget, we got other things happening, and, mate, there's lots to talk about.
There is, but what I'd be keen to know from all of you out there right now is if you got any burning questions. Do you have questions on oil? Do you have questions on interest rates? Do you have questions on Ukraine? Do you have questions on equity markets? Whack them in. Let's see if we can talk to what you want a little bit, because I've got the full box and dice today. I've come fully loaded, and I'm happy to go anywhere we need to go. But while we do that, I'll just go into another Yogi Berra quote.
You love Yogi.
I do love Yogi. God bless him. And you can observe a lot just by watching. And it may sound silly, but sometimes people look, but they don't see. Sometimes people see, but they don't understand. It's kind of like what I say, or devil's advocate. Taste, but don't feel, but I can't remember. I'm going to butcher it. Anyway, let's get on with it. So what's not in the news, Jason? What's not in the news that we love?
Mate, put yourself in the top left-hand corner.
Top left? There you go.
There you go. Boom.
All right. You're right down there, mate?
Indeed.
So what's not in the news? COVID's not in the news, and we're coming into winter. Thank God for that. Yes. What else isn't in the news? And I think we're all pretty appreciative. I'm going to keep bringing it up. The less that we see of these two, the happier everyone is, isn't it? The happiness index has actually gone up in Australia, and I'm pretty sure it's because these two people are not in the media. So let's have a look at a couple of little things that are in the news, and then I'll get in some burning statistics. But I'd love to know what you guys want to know. So if you want to know anything about inflation, oil, conflict in Iraq, markets, whack it in there. We'll get to it. This is really interesting. And mate, we kind of pegged this a couple of weeks ago, and we were talking about it. Civil contractors say they are hugely stretched due to soaring prices and have called governments to follow Queensland's lead and bear more of the costs of building materials. Well, I could say a lot, but I'm not going to. All right, I know far too many people in this sector who have made an extraordinary amount of money, but no, I won't. I'll end up with a horse's head in my bed one day, so I'll just keep that one to myself. But the reality behind this is, of course, infrastructural projects are going to have big impacts. Think about the budget that was set for the Brisbane Olympics. Think about where that's sitting right now with oil prices, with steel prices, with all of these different price rises. Understand that these price rises may well be limited to how this tension in Ukraine pans out. And I've got a few things to say about that soon. But this is a real thing, right? So we are going to see infrastructure costs increase. Petrol costs are obviously through the roof. That flows through. So what we need to be thinking about as investors and through the economy is, well, anybody who drives a car, anywhere, anybody who drives something that's not a Tesla or one of the few other cars out there that are powered by other sources, if they relate to business costs are going up. So this is the first of many, many articles that we're going to see, and it's going to keep on going while the Ukraine crisis continues to go. So we sort of called that. The effects may be well short-term, but here's the thing. That's what I wanted to say with this. You can be damn sure that by the time they make a decision on this and start to help out, that the effects of whatever's going on in the Ukraine will have stopped. The prices will come down, but the subsidies that go into those markets will still remain the same. That's my future call, allegedly. Andy said it now. That's just bad budgeting, but we'll see how they do. Scientists have an insight into what happens to someone when they take enough psychedelics to experience hallucinogenic effect. But little research has been conducted on the effects of small doses. I'm pretty sure, Jason, that's because the scientists are too busy getting off their chops to try and figure out what's actually happening with the small doses. Amazing. Like, why start the study on the micro dose when you're just still having too much of a good time on the other side of it? Incredible article. I just thought it was fun. And this one, this one's another classic, Jace. This is this is just when you have no consequences of the purse strings that you flow to the world. Like if you had an endless ability to print money and no ramifications on it, like the things that you would do would probably be humanitarianly just amazing. But when you're a politician, it's quite staggering. So the coalition is being urged to extend its incredibly successful, that's the word I love about this, apprenticeship wage subsidy before it expires next week. Well, hello, not rocket science. When you subsidize 50% of an apprentice's wage, do you think that there's going to be a fair few people who are saying, no, don't stop. Here's the thing, Jace, is that it's almost a blanket. And it's like, well, if building and construction are going berserk, and I'm not picking on the builders and that out there, that's not what this is about, right? Because clearly the politicians are not going to listen to Jason and I. But if you're having your best year yet, and you're just absolutely crushing it, but the medical field needs more apprentices, well, why wouldn't you just tweak and balance that out? Now, the reason why I say this is we've got an incredible friend, Heather Gardner, incredible in the RTO space, knows this sort of stuff backwards. She sent us a list of the available occupations for these apprenticeships. You would be staggered. You would be staggered to see the list, Jace. You would be staggered to see who's not on the list.
On the list,
like medical fields, nurses, all of the things that the government is saying that they're trying to increase. Allegedly, because I'd have to go back and take a double check because there are many, many sectors on there. But mate, quite clearly, if you're going to offer a 50% wage subsidy for apprentices out there, they're going to be pretty unhappy when you take it away. Not a lot of news there, I don't think, but I thought it was interesting. This is something which drives me absolutely bonkers, mate. We make up 2% of the world's GDP. Ladies and gentlemen, put it in the chat box. What percentage of global GDP do we make up for? 2%. Whack it in there. 2%. And if you get the chance, what's the other side of 2%? Whack that in there as well.
Are you talking Australia? Yeah. So Australia's
Australia.
GDP. Yeah.
Australia's GDP, 2%. So Prime Minister says that the participation of Vladimir Putin in global forums after accusation of war crimes is a step too far. So Morrison's been poking the bear a fair bit down here in Australia, and I kind of think that we're 2% of the global GDP. Russia, substantially larger, fair to say. Yeah. China, substantially larger, fair to say. Do we rely on both of those countries? Fair to say we kind of do. So I don't know, mate. Scott Morrison obviously knows how to pick a mark, though, doesn't he? Like he's our prime minister. See, you'd think I was a Liberal boy until right now, wouldn't you? You'd think he'd be able to pick a mark. So, but he doesn't have a great track record of picking his mark very well, does he? Because, he tried to pick this mark once upon a time and she tore him to shreds. And now he's got someone who's 6,000 nukes in his hand. Maybe Scott should just choose his battles a little bit, or just be quiet, because we make up 2% of the global GDP. And maybe we should just kind of chill out here in the background. We can have our opinions. We can think what we want, but maybe let's figure out how we can handle grace before we go for Putin. Just saying. I don't know. And I know they're both contentious issues, but
Mate,
getting into the more real stuff. I was just waiting to see what you guys wanted to have a look at. So Dave's saying, what are some good share sectors to invest in that are affected by inflation more than others? Temporary wage increase. Okay, so we don't have too many questions that are coming through. Well, let's have a look at this. There's a couple of great slides in here, Jason. I'd be interested to know what you want to know in the next 5 minutes, because there's about 4 hours worth of content I've got up my sleeve here.
Yeah.
But maybe we go to the velocity of markets. And so that red line there, so we've got the US market here. All right, so this is the US market, and March. Oh, you wouldn't believe it. My pen's lost its thing.
Lost its virility, mate.
I don't quite know how to respond to that. Actually, you know what? I think I can plug it in.
Plug it in. Yeah.
I think I can get this thing happening while we're here.
Well, it's interesting to see like this, and while you're doing that, Andy, like what I can see here, and this is, team. Andy showed some history stuff like this before. Like something happened, it shocks the world, and then everyone goes, "Yeah, well, fuck it, let's get on with it," right? The human spirit is one of like, we can endure, we can do it, we can fix it, we can continue. And as an investor, that's the foundation piece, Andy. And I don't want to seem insensitive, but let's just put this aside. Wars, bloody, COVID, changes in political stuff, like economic, like the GFC. Folks, to be honest, like those things are temporary and momentary. Like they're not long term. And it's bloody hell. It's such an interesting thing to see those things in a chart like this, Andy, is probably my point. COVID, everyone shit themselves. The world's going to end. No, it bloody won't.
It was over. It was over. And mate, I can tell you, there are a few moments where I said to myself, this is going to be different. This is going to be different. But and maybe Ron will be watching. There's a good mate of mine, Ron Koharski, good Polish name. Good mate of mine for many years. Haven't chatted with him for too long, but we were talking about it. We're like, what's the next thing? And pandemics were one of about 5 things. So we had nuclear war, we had pandemics, because the same thing doesn't happen again. Different things happen. Because we actually do learn to a degree by our mistakes. And so this was definitely on the cards. But I thought at one point in time, is this going to be different? And then you and I had a bit of a conversation. You snapped me out of that bit of a funk, because sometimes you can get into a bit of a funk. Like, Andy, this is the opportunity of a lifetime. Like, that was what one of my best teachers ever taught me in the world of investing. And it was, when everybody's scared, look for the opportunity, because everyone's too scared to see it. But if you're willing to not be scared, it's just going to smack you in the face, and then you're going to think that it's too good to be true. So you probably are going to doubt yourself, and that's then the true testament of an investor, a real investor who's going to make some calls when things get pretty hairy out there, pretty much like what you did, mate. To be fair,
Yeah.
So this is COVID down here. Oh, it didn't charge up, but the white line is COVID. Sorry, the yellow line's COVID. Now let's have a look at the US and then Australia. So Australia up about 62% since the biggest thing that's happened in Australia since the GFC. Right, US up 99%. Check this. Oh no, sorry, I'm saving it for later. So Jason, putting you on the spot, putting you on the spot, and all you out there. What country in the world do you think since the beginning of the year has actually had a positive share market? What country in the world?
You're talking 2022?
I'm talking 2022. Up to now, it's actually been in the green since the beginning of the year. What country? And then it's coming. And then what sector do you think, out of all of the sectors in the world, what sector do you reckon is the one sector? Now that's a little bit easier. What's the one sector you think that's been positive? And we're going to jump into this. This is a bit of fun. So Jason,
I don't know about the country, but I'm going to go bloody real estate. Industrial real estate's been killing it. That's my sector. But anyway, maybe I'm wrong, but maybe I'm one-eyed. Tech, says Gary. Gary says tech.
Since the beginning of the year, Gary. Since the beginning of the year. Have a look at that graph. Have a look at that graph.
All right. China.
It's China.
Dan saying China. Australia mining. Hey, actually, that's not bad. Actually, I'm going to change my answer. Can I change my answer?
You can. I don't think there's a war index, Joe.
I'm going to say energy. I'm going to say the energy sector. And I'm going to say, the US.
Oh,
I don't know. Renewables. Oh, look, here we go. Aaron said renewables.
We've been talking about it a lot, Jace, you and I. We've been talking about this country quite a lot.
Japan.
Been through this before. Japan
UK.
is actually up there, but it's the UK. But Japan is one of the better performers, one of the best performing markets around. But the UK, we've been giving them a fair bit of stick recently because of everything that they've gone through, but they've been punished so badly that I think the only reason they're positive is because they were so negative before. You know the old the old joke. You know how to tell the plane has come from England? When the engine stops, you can still hear the whining. But anyway, so no, I'm just joking. I love my English friends. So, but England had been punished, and Japan is now actually starting to push the positive as well. So, Jace, you were pretty much smack on the money. Japan's actually done very, very well recently. But asset class here, so let's have a look. Global asset class returns year to date, everything negative apart from the United Kingdom. But the United Kingdom had been smashed to smithereens. We do then have Japan, who is one of the close quarters there, and emerging markets. Japan's one of the closest, and inflation-linked bonds. So Japan is actually the front runner next to the UK, mate. So you're pretty much there. So, but ladies and gentlemen, Jason Witten has picked it. The property guy has picked the sector that has performed positively from the beginning of the year. Let me jump out of the way there as well. So global sector returns year to date, and having a look in here, financials just down a little bit. Materials just down a little bit. Utilities just down a little bit. Consumer staples, interestingly enough, just down a little bit. Industrials, healthcare, real estate. Now remember that these things all went absolutely berserk. Berserk. And now, obviously, energy prices, oil, but it's not just oil that's kept it up. It would probably be just a little bit negative if it weren't for oil prices right now. But this is certainly a sector. Now, the oil parts of that sector might get reasonably aggressively hit in the future, but 100% kudos to you, Jace. The energy sector has been the big winner. But here's the thing is that, and I won't talk to that. There's a couple of things I want to talk to, but geez, I've got so much to talk about. One of this is the theme. And you and I have been talking about the value rotation, and you talk about, growth properties versus value properties, income producing properties versus, growth producing properties. And as we sort of wrap up tonight, maybe I'll lay a few seeds.
Yes.
And ladies and gents, there's so much more of this. We can jump into oil, everything. I've had some incredible conversations with incredible smart cats recently, and I've got some incredible data that's sitting behind here.
Like that's mind blowing right there, Andy. Like, as folks, just look at that. Like, look at 218 to 220 and the pandemic, and it's like, has it doubled or almost tripled?
320% the FANG index, but the FANG index is Meta or Facebook, Amazon, Apple, Netflix, and Alphabet.
Wow.
Right? That was an index. That was the point being is that index is now so big. You've got Apple, $1 trillion, and all of the Apple, Alphabet, I think hit trillion. Could be wrong. Definitely Apple. I've forgotten one of the others made the $1 trillion market cap. So these companies statistically distort the total market.
Yeah.
And so when you turn on the television, I was about to say the wireless.
The radio, Andy?
Yeah, the old radio, where you hear whacking, floating, inflatable salt band is promoting the most brilliant thing there that's never, ever been beaten. No, it's the wireless. When you look at this, there's been a huge take forward on the FANG index. So the FANG index is the blue one. That's the big one. That's the big tech giants. And that is such a massive part of the market. It moves the market upwards. So underneath that, you've then got the S&P 500 tech, all right? So this is all of the tech stocks. Yes, Bob, it includes Tesla. Yes, Chris, Bob, Allison, it includes these countries. Bob, it doesn't include Russia or gold. But it does include it's the tech of the 500. So the tech stocks of the American top 500 companies. Have a look at where the S&P 500 sits in comparison.
Solid. Yeah.
Pretty solid. So as money flies out of these very, very high growth stocks, it goes somewhere. It doesn't necessarily go to cash. It goes somewhere else. And
yes,
I just want to find this one for you because maybe this one just before we go.
Well, the money seeks value, Andy. Like team folks. And maybe one day, Andy, you and I will maybe do one of Wine and Wisdoms, or maybe we'll do something in person. Chuck it in the chat if you want to hang out with us somewhere cool one day, and we'll do a full day in person Wealth, Wine and Wisdom. Because
that would be fun.
Gee, we'd be bloody pissed if we drank wine for a day.
Maybe it'll start off as wealth coffee chats. Then it'll be dine and delve together, and maybe we finish off with a little bit of wine and wisdom in the evening. Maybe that's the agenda. That's a great question, mate. I'd be super keen to know if people would love to do that. Whether they'd be keen to catch up and have a bit of a.
We got a few keen beans here for sure. We might hang out somewhere cool. Last time Andy and I hung out and we talked high level, big level, we hung out in an $8 million penthouse overlooking an amazing river, an amazing city. It was pretty cool. So if you're up for it, chuck it in the chat. I know a few of you guys are there. So we've got a few takers, team. Yep.
What's the number that we need, Jace? Let's throw a number.
Absolutely. We can do it in person, Carolyn, for sure. Yep. We've even got... I actually said I'll pay now. Where they get the credit card details? Well, reality is it'd be great to do this with 20 cool cats. Absolutely. So, because at the end of the day, Andy, right? Folks, we need to rise above this. So, money is energy. And when you store energy somewhere where it doesn't move, it loses its ability to have charge, right? And it has to move. It has to keep moving. What it does do, money leaves behind something, and if you direct it in the right way, it can leave behind an asset that can create renewable energy. Money directed in the right way is like renewable energy. It's like this, like a solar panel, right? If you invested in a solar panel, you're going to get energy for the rest of your life. If you invested in if you invested in a gasoline car, well, you've got to keep putting shit in it, right? That's just the facts of it. I don't know. I think I might have to build that analysis out, Andy. But you know what I'm trying to say here, folks.
I'll put a pin in it with this one, Jace, and you'll love this. Money, like you said, is looking for perpetual energy, right? And it's always looking for its highest and best use. It's like water. It floods to a natural gravity where it has its optimum use, right? And ultimately, water is there to absorb caverns or to sit in caverns, and it's there in order to be able to feed and generate and provide for the world at large. And if we have a look at this, and so for those business owners out there, this is the reason why the holy grail is to list on the NASDAQ. Sorry, not the NASDAQ. It's just to list your company. This graph, so what I want you to have a look at is the US, which is the blue line. And what I'd love you to look at is also developing, right, which is a little bit of Australia in there. Now, the figure that you can see on the far right is the price to earnings ratio. And what that means is that just until recently, if you invested on the average company across the top 500 of the US, you had an average earnings multiple of almost 20%. So let's put that into context. Ooh. If your business was earning $1 million, then somebody would come and buy your business, Jason, for $20 million.
That's a good number, Andy. That's a good number.
That's a great number. That's a great number. I think there'd be quite a few of the business owners watching this that if we could get those multiples, we would have retired by now. But have a look at how that's changed over time. And then when we think about that graph that I put up previously about these tech companies, which actually don't earn a lot of money for how big they are, some of them do, but in comparison to how big they are, $1 trillion, does Apple earn $1 trillion a year? No, not for the next bloody 100 years. It's not going to, potentially. Nowhere near it. It is 19 times or above. I think their multiple is actually significantly higher.
Yeah.
So here's the thing. You got the tech companies that are big earnings multiples pushing it through the roof. You've got other companies which have lower multiples like yours and my businesses, Jace. We've got far lower multiples that we're going to get for ours. Money, like energy, is going to find a course in order to produce its maximum potential return. Now, if that's the sun going into a solar panel and producing it for free, that's what's going to happen. If it's going into an oil mine in order to produce oil so that we can have it at 80 cents. Do you know it was 80 cents a while back, Jace? 80 cents a barrel, and it went over 100 recently. It'll go to oil. Money will find its natural flow. It'll find where it can be its evergreen and its best version of itself. And Jace, you're the one who told me this expression. It'll find its highest and best use.
Yes, mate, dead right, mate. That's a good. I think, folks, that's a perfect spot to leave tonight. The highest and best use of all of our resources. You know, what does it look like for you? What does it look like for the world? What does it look like for your portfolio and your investments? Great bloody question. And, it's one for us to all design together, mate. So, mate, enjoyed tonight, mate. Hopefully, folks, you guys have had a bit of fun. Andy and I have. I've drank way too much wine, Andy. Committing to 2 drinks have turned into 3. So,
cracking bottle. Well, put it back up there, mate. I want to see it again because it's a while since I've had a bottle that good. It's amazing.
Absolutely fantastic bottle of wine. It's too easy to drink, and that is the problem. And I'm probably slurring now, so my wife is going to be texting me in a minute. Get off, you idiot.
Well, that's always a good time to put a pin in it, isn't it?
Mate, good to hang out with you. Fantastic to have you guys online tonight, folks. Really appreciate you guys being here. Really,
you guys. It's
appreciate
awesome.
your
Thank
support. You. Yeah. And until next week, it's a good night from him.
And it's a good night from me. Good night, everyone. Have a great weekend.